5 years ago, I started my self-directed investing journey with about $400 a week in cash flow before expenses. I didn't have much direction, but I knew one thing. I needed to experiment while liquidity conditions were favorable. In those early days, I was chasing returns wherever I could find it, and it worked until it didn't. When favorable liquidity environments dried up, my $7,000 account had doubled to 14 grand while liquidity expanded, but as it contracted, I watched it bleed all the way down to $3,000. I tried to catch falling knives in my first real bear market, and I paid the price. Even through those losses, I remembered the small wins. The first time I made $1,000 in a day, the first time I doubled my account over a year. Those wins kept me grounded because if I could do it once, I could do it again, but better. Looking back, those wins weren't random. They were tied to one thing. That one thing is systems. Even in my early success, I was unintentionally following a structured dollar cost averaging strategy. All I needed to do was refine and scale that system intentionally. I started allocating a set amount of capital every 2 weeks. I held cash reserves for more severe dips. I focused only on assets where I did deep research into fundamentals, leadership teams, project history, financial strength, stocks, crypto, real estate. Each asset had its own system calibrated for its own unique risk profile. At a certain point, you have to think beyond just strategy. You have to think in terms of edge. But there's a catch here. Edge without a system is liability. It's just ego disguised as skill. So the second you think you have an edge, but you don't have a disciplined system to support it, you're gambling. Maybe not in a way that feels reckless, but structurally, it's the same as a casino model with a negative expected value or a negative embedded edge. I think the free markets are special because unlike most fields that you could step into with a low barrier to entry, they allow the average self-directed investor to create their own positive embedded edge. But to do that, you need a system. Risk-adjusted returns, Sharpe ratios, Sortino ratios, trading rule sets, dynamic risk parity, delta-neutral hedging and skewing. These aren't just academic terms. They're essential tools to make sure you aren't bleeding capital without realizing it. So every capital management system has one job: maximize upside potential and minimize downside risk. The big mistake I made early on was thinking risk was something you just accept. Later, I realized you don't accept risk, you engineer around risk. The better your risk management, the more upside you can afford to seek. So risk management isn't just protecting your downside, it's actually what lets you scale your upside safely over time.